My name is Mark Nodal. I'm a financial advisor and I lead the wealth management division of the Noble Group. Let me take a stab at a few of the challenges you are facing today. Like I've got no time to manage my money. The amount of investment choices today are overwhelming. All financial advisors are basically the same. I really don't know what advisor to trust. One of the biggest challenges of them all? Portfolio results. Let's get right to it and talk about that for a second. A quick story. I spent over 23 years as a financial advisor at big wirehouses, and I was always taught to be a gatherer of assets. And when I get a new account, diversify the client's assets and always stay 100% invested, no matter what the market conditions are. After all, the market historically goes up over time. There's a problem with that. The big wirehouses don't have the relationship with the client. They don't have to look in the eyes of a client after the S&P 500 is down 3 years in a row, like in 2000, 2001, and 2002, as account values declined. I did what my company wanted me to do, but I only did half of what my client expected me to do. I'll never forget, just after this recession ended in 2003, being told by my client that it doesn't make me feel any better to be told that the market is down, and so is everyone else. I don't care about everyone else. That's when it hit me like a ton of bricks. What could I say? I understood how my client felt, and I knew right then that I had to figure out a better way of managing client assets. We believe the most critical factors in growing assets are managing risk and limiting investment losses. I urge you to focus on the rest of this video. Then decide if you would like to get to know us, so we may help you achieve your financial goals. Individual investors face tough challenges to growing a portfolio and preserving wealth. Gone are the days of buy and hold and hope. Here's why. The markets move in long-term cycles known as secular bull and bear markets. We're not in a secular bull market anymore. We've been in a secular bear market since 2000. In this chart of the S&P 500 from 1900 through 2010, the secular bull markets are in green and the secular bear markets are in red. Let's look at the difference between the two. This is the last secular bull market that lasted 17 years from 1982 through 1999. Here is the S&P 500 over the same period. See how it looks similar to an up flight of stairs? In periods like this, buying and holding something similar to the S&P 500 has the potential to work great. But in a secular bear market like the one we've been in since 2000, markets tend to move sideways, going up and down, and at the end of the day, the S&P 500 is lower at the end of 2010 than it was at the beginning of 2000, 11 years ago. So you can see that buying and holding may not work very well during secular bull markets. If you want more information about secular bull and bear markets, see my video, Why Buy and Hold Isn't Working. Let's put this into perspective. Each of us has limited time on this earth. This is a little high, but let's say the life expectancy of an investor is 90 years of age. I found that it takes until around age 40 for most people to accumulate meaningful investment assets. Let's say that on average investors want to retire or quit working so hard around age 67. That means on average, I believe investors have 25 to 30 years to grow their money until needed in retirement. The average secular bear market lasts 17 years. The average secular bull market lasts 12 years. If you happen to hit a secular bear market during the green period and your assets go up and down and don't grow over the average length of a secular bear market, you can see that you will not have many years left in which to grow your assets until you need them. Now, you could get lucky and hit this period during a secular bull market. Think about yourself. We've been in this current secular bear market since 2000. Can you afford to buy and hold? Now, let's shift gears and look at the key tool we use to limit risk and help preserve client assets from big down markets, the 10-month moving average. Similar to a traffic light where green means go and red means stop, an asset class trading above its 10-month moving average is represented in green, and when an asset class slips below its 10-month moving average, it's represented in red. This chart will help me explain by looking at U.S. stocks from 1901 through 2008. This number circled in green means that for more than 100 years, U.S. stocks traded above their 10-month moving average about 70% of the time, and circled in red, 30% of the time they traded below their 10-month moving average. When trading above the 10-month moving average, annual returns of U.S. stocks on average were almost 14.5%. And when they were trading below their 10-month moving average, the average annual return was just a mere 3%. Plus, annualized volatility is a measure of risk. U.S. stocks were almost 70% more volatile when trading below their 10-month moving average and only returned 3%. The moral is, when an asset class is trading above its 10-month moving average, the green light, it has historically produced more return with less volatility. So you may want to consider investing. And when you have an asset class that moves below its 10-month moving average, the red light, you may want to consider moving out of this asset class to help preserve assets. Let's look at practicality. Here's a 10-year chart of the S&P 500, the black line, and the brown line is the 10-month moving average. The years show at the bottom. As you can see, the S&P 500 moves above the 10-month moving average in early 2003, giving the green light, and it stays above it until the end of 2007, where it crosses back below its 10-month moving average, which is the red light signal to preserve assets by moving to cash alternatives. Right here was the top of the market. How would you have liked to have been out of the S&P 500 through all of 2008 instead of riding the market all the way to the bottom? Then in mid-2009, the S&P 500 moved back above its 10-month moving average here, giving you the green light again. We follow the 10-month moving average of every asset class positioned in our clients' accounts. I discuss this more in detail in my video, How We Help Preserve Assets in Down Markets. We recommend diversification to help reduce risk. During difficult markets, we believe that our clients are better served by using an absolute return strategy rather than a strategic asset allocation strategy, which is the old buy and hold modern portfolio theory. We have developed a couple of absolute return strategies that are designed to not only help grow your assets, but also help preserve them along the way by following the 10-month moving average. These are the Pride Rotation Portfolio and the Value Masters Portfolio. Have you heard the phrase, "There is always a bull market somewhere"? The Pride Rotation Portfolio is designed to find the asset classes that are in a bull market every month and invest in them. The key to this momentum-driven strategy is following low-correlated asset classes. These are U.S. stocks, foreign developed country stocks, the long-term U.S. Treasury bond, commodities, and real estate investment trusts, or REITs. At the end of each calendar month, we average the last 3, 6, and 12-month returns for each asset class in order to isolate the two asset classes that have the most momentum. We invest 50% of the assets in each asset class as long as both asset classes are trading above their 10-month moving average. Remember, we want the odds in our favor. The idea is to ride their momentum until another asset class overtakes it. If one or both of the two isolated asset classes are trading below their 10-month moving average, the assets are placed in cash alternatives or money market for that month for asset preservation. We believe the best stock pickers in the world are the managers of well-established hedge funds. Did you know the very best hedge fund managers must disclose their holdings to the Securities and Exchange Commission by filling out Form 13F? Their stock picks are public information if you know where to look. We isolated 17 of the most outstanding value-style hedge fund managers listed here and used the information found in their 13F filings to develop a strategy we call the Value Masters Portfolio. On a quarterly basis, the strategy is to buy the 10 most popular, widely held holdings from each of their top 20 holdings. For example, the more managers that report a security as a holding, the more popular it is. Each of the 10 stock picks are weighted based on how popular the holding is amongst the group. Even though you may have great stock picks, there are times when the odds of making money in the market are against you. For these times, the portfolio as a hedging process designed to help preserve assets and is implemented when the S&P 500 goes below its 10-month moving average at the end of any calendar month. When the S&P 500 moves back above its 10-month moving average at the end of a calendar month, the hedge is sold and the proceeds are invested back into the stocks, returning the portfolio to 100% invested. In summary, we believe that building a portfolio to buy and hold and keep your fingers crossed in hopes that the market goes up may leave you vulnerable to big down markets and can have a significant impact on your plans later in life. The assets we position in clients' portfolios are designed for growth potential and asset preservation along the way. If any of the issues discussed in this video have caught your attention, you might want to consider our no-cost second opinion service, especially if you feel like we do, that asset preservation is as important as asset growth. Like obtaining a second opinion from a doctor, a fresh pair of eyes on your current financial holdings to see if you're properly positioned may prove beneficial to your confidence. We go through a discovery process to uncover who you are, what you care about, and what you're trying to accomplish to make sure that your financial investments match. Thanks for taking the time to view this video, and if you would like to take us up on our no-obligation second opinion, here's your opportunity.